The rejection that almost killed a $100 billion idea. In 2008, 3 founders walked into Silicon Valley with a simple proposition. Let strangers stay in your home. 7 investors said no. 8 said no. 9 said no. 1 called it crazy. At the time, they were asking for $150,000. Today, that company is Airbnb, a global marketplace that would eventually go public at a valuation near $100 billion. But the real story isn't about disruption. It's about capital allocation, investor psychology, liquidity pressure, and the disciplined decisions that turned survival into dominance. This is not a startup fairy tale. This is a study in how money moves and how conviction compounds. In 2007, San Francisco hotels were sold out during a major design conference. 2 designers, Brian Chesky and Joe Gebbia, inflated air mattresses in their apartment and charged guests to stay. The revenue was modest, but the signal was profound. Strangers were willing to pay for temporary access to underused space. The global hotel industry was worth hundreds of billions, yet millions of spare bedrooms globally produced zero yield. Financially, this was inefficiency. Real estate sat idle between uses. Fixed assets produced no return during vacancy. The founders weren't disrupting hospitality. They were monetizing underutilized inventory. Investors saw risk, reputational risk, operational chaos. They saw downside. The founders saw asset underutilization, millions of spare rooms, idle capital in physical form, and they asked a powerful financial question. What if we turn fixed assets into yield-generating inventory? In 2008, the company was nearly broke. Revenue was inconsistent. Growth was slow. And then, the global financial system collapsed. The same year Lehman Brothers failed, Airbnb was trying to raise seed capital. No one wanted risk. Hospitality demand was contracting. Liquidity everywhere was tightening. So they did something unconventional. They designed political cereal boxes, Obama O's and Captain McCain, during the US election. They sold them for $40 each. They made roughly $30,000, not because cereal was scalable, but because survival buys time. This is the first financial lesson. Liquidity is oxygen. Cash buys optionality. They later entered Y Combinator, where Paul Graham advised them to focus obsessively on users, not investors. Instead of chasing valuation, they chased retention. Instead of pitching growth curves, they manually photographed hosts' apartments to improve conversion rates. Revenue improved, unit economics stabilized, and investor perception slowly shifted. Acceptance into Y Combinator marked a shift from improvisation to focus. Paul Graham pushed the founders toward obsessive user improvement rather than fundraising theatrics. They personally visited hosts. They photographed listings. They optimized conversion rates manually. Revenue per booking improved. Retention strengthened. The breakthrough wasn't scale. It was trust infrastructure. They built verified profiles, reviews, host guarantees, secure payments. Trust is not emotional. Trust is financial. When users trust a platform, booking frequency increases, price sensitivity decreases, supply expands, CAC drops over time. Trust compounds. Investors began to see something different. Not a couch-sharing experiment, but a two-sided marketplace with network effects. Capital flowed in. Series A, Series B, international expansion. But notice the order. Revenue signal first, capital second. This reverses how many founders think. Money follows proof, not pitch decks. Airbnb's true breakthrough was not growth. It was trust architecture, verified identities, host reviews, secure payments, guarantees. Each reduced friction. In finance, friction increases risk premium. When perceived risk falls, transaction frequency rises. That shift altered lifetime value metrics and lowered customer acquisition costs. Reviews became data. Data reduced asymmetry. Reduced asymmetry expanded liquidity. Investors began to see network effects forming. Each new host increased geographic density. Each satisfied guest strengthened reputation. Trust converted behavioral hesitation into economic velocity. Capital responded accordingly, and successive funding rounds followed, demonstrated traction. Unlike traditional hotel chains, Airbnb did not purchase land, finance construction, or manage physical properties. Its expansion required software infrastructure and compliance adaptation. Hosts supplied the assets. Airbnb supplied the marketplace. The financial consequence was operating leverage. When booking volume doubled, marginal cost did not double. Revenue scaled faster than fixed expense. Expansion into Europe, Asia, and Latin America accelerated supply density. The company increasingly resembled a global liquidity exchange for temporary space. Asset-light models attract capital because they convert growth into margin more efficiently. Investors saw not just bookings, but scalable economics. Investors learned a second lesson. Platforms that convert idle assets into recurring yield are capital-efficient machines. By 2017, Airbnb had listings in more countries than most hotel chains. But growth brings scrutiny, and scrutiny brings regulation. Success triggered resistance. Cities concerned about housing supply and tax capture imposed regulations. Compliance costs increased. Legal teams expanded. Political negotiation became operational reality. Growth in major cities slowed under scrutiny. Financially, regulatory friction adds cost layers and compresses margin. Yet regulation also signaled permanence. When governments regulate an industry, they implicitly acknowledge its durability. Institutional investors often interpret regulatory frameworks as risk formalization rather than existential threat. Airbnb invested heavily in policy engagement and tax agreements, shifting from insurgent to participant. The cost of legitimacy was high, but legitimacy unlocked broader capital acceptance. In early 2020, global travel froze. Revenue dropped sharply within weeks. For an asset-light company dependent on mobility, this was existential. Marketing was cut. Staffing reduced. Debt was raised at unfavorable terms to preserve liquidity. Cost discipline became immediate and surgical. The decision to preserve cash, even at reputational and dilution cost, ensured survival. But something structural emerged. Airbnb's distributed supply model adapted faster than hotel chains bound by fixed occupancy thresholds. Rural stays and domestic travel rebounded first. The platform shifted toward longer-term stays and remote work demand. Flexibility became financial resilience. When Airbnb debuted publicly in December 2020, markets interpreted its survival not as luck, but structural proof. The public offering of Airbnb in 2020 priced above expectations, reflecting investor confidence in platform durability. Valuation was not merely a reward for growth, but for demonstrated crisis adaptability. Public markets prize predictability of future cash flows. The pandemic stress-tested Airbnb's model. Its rebound signaled long-term demand elasticity. Institutional capital re-rated the company from speculative startup to global infrastructure layer in hospitality. Early rejection contrasted sharply with public enthusiasm, illustrating how investor psychology evolves alongside data. Airbnb's journey reveals patterns in how money behaves. Early-stage investors avoid uncertainty during macro stress. Proof of repeatable revenue shifts perception. Asset-light scalability attracts institutional capital. Regulatory friction is costly, but stabilizing. Crisis resilience commands premium valuation. Most importantly, survival preserves the right to compound. The founders did not respond to rejection with theatrics. They responded with measurable improvement in unit economics. That shift transformed narrative risk into financial credibility. Lesson 1. Optionality beats perfection. Early survival tactics preserved runway. Lesson 2. Trust infrastructure is monetizable. Platforms that reduce friction increase lifetime value. Lesson 3. Asset-light models scale faster in crises. Lower fixed costs mean greater adaptability. Lesson 4. Downturns reveal structural strength. Weak models break under pressure. Strong ones bend. Lesson 5. Capital is attracted to predictable cash flow. Narrative gets attention. Margins get funding. Global capital cycles are tightening again. Interest rates remain elevated in many regions. Venture funding is more selective. Investors demand profitability pathways, not just growth projections. Airbnb's trajectory demonstrates that the strongest businesses often look fragile in their earliest phase. Behavioral skepticism frequently precedes financial acceptance. Platforms that convert idle assets into liquid markets possess structural resilience, especially during volatility. For founders and investors alike, the enduring lesson is discipline. Liquidity first, unit economics second, scale third. Airbnb did not become dominant because it was flashy. It became durable because it survived multiple capital winters. Rejection forced efficiency. Scarcity sharpened focus. Crisis revealed structural strength. In finance, survival is not passive endurance. It is active capital management under pressure. Every decision, from selling cereal boxes to cutting costs during a pandemic, had financial consequences. Each consequence either extended runway or strengthened resilience. Over time, resilience compounds, and compounding, more than charisma, builds empires. If this changed how you see money, subscribe. These documentaries are built for thinkers, not spectators. And if you're serious about mastering capital, watch the next video on your screen.